Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. While the rest of the market heads towards a correction, the financial sector has held up extraordinarily well. And one name that's caught our eye is Capital One Financial. Unlike most traditional banks, Capital One focuses more on lending services, specifically credit cards. That gives it a different exposure to rising interest rates, which benefits the company. You see, financial service companies like Capital One make more money as interest rates rise, because the rate they pay depositors rises at a slower rate than the rate they charge borrowers. After we pulled the top searches for financial services companies amongst financial pros, two names floated to the top: Capital One and Ally Financial. Both offer fantastic values, but for different reasons. Capital One struggled with declining net income from 2014 to 2017. But the company turned things around, driving substantial growth in 2018. That faltered in 2019 and 2020, only to make a huge comeback in the last 12 months. Free cash flow has consistently landed north of $10 billion since 2016, and above $33 per share in the last 2 years. And with shares trading at $150, that's roughly 5 times free cash flow. While Capital One was forced to cut its quarterly dividend by 75% in 2020, they restored it in Q1 of 2021. Since then, management has hiked it by 50% and announced a special dividend of 60 cents per share. For 2022, the board allocated $5 billion in share buybacks, or around $11 per share in total value. Capital One's valuation is outstanding compared to the financial services sector and the company's own 5-year average. With a P/E ratio of 5.6x, Capital One comes in at nearly half the price of the rest of the sector. Even with the expected P/E ratio set to rise to 7.6x next year, that's still more than 35% below the sector average. When we compare Capital One to its historical average, we find it trading at a relative discount based on earnings and cash flow. The one area that it's a bit more expensive in is the price to book. However, both the trailing and forward-looking price to book ratios are below the industry average. In our opinion, this is an 8 out of 10 stock. And Capital One's focus on credit cards and lending exposes it to interest rate changes more than larger financial institutions, like Citigroup, which has a more diverse income structure. That's perfect for an environment where rising rates boost the company's bottom line. And with consumer spending continuing at an unprecedented pace, we expect management to keep returning cash back to shareholders. Click and subscribe to the Spill newsletter to get the full breakdown.